This data center darling is dropping like a rock this morning. Arista Networks, ticker ANET, is down about 8% after reporting what many people are saying was a pretty good earnings report. So let's find out what happened with this earnings report and if Arista Networks is a buy on the dip today. So like I said, Arista Networks is a data center darling. In the past year, the stock is up about 58%. In the past 5 years, it has 7x'd. So this is a very, very strongly performing stock. But all of a sudden, it seems to have dipped a bit. In the grand scheme of things, this is a pretty small dip. But if you're somebody who's looking to get exposure to data center stocks, maybe this is a nice opportunity. So the reason for the dip, like I said, is Arista's full year and quarterly Q4 earnings results. Even though the company raised their full year revenue guidance to 17% growth, up from 16% growth, it fell short of Wall Street's estimates of 19% growth. So that should tell you something about the state of the market. It's not enough to be good. You got to be better than people expect, right? This article from Barron's says that Meta is partly to blame for Arista's earnings. They say that Meta's contribution to sales fell to 15% from 21% the previous year. So I think to really understand the implications of this, it helps to know what Arista Networks does. So let's dig into that first. So this is Arista Networks 10K. The 10K is an annual filing that every publicly traded company on one of the US stock exchanges needs to file with the SEC every year. Unless you're a super microcomputer, then it's fine if you just wait a couple months and you're a little late. Jokes aside, this will give you all the info you need about a company. It talks about the risks, it shows their financial statements, it talks a bit about what they do. This is a very rich document. So if you're starting to analyze a stock, it really helps to look at the 10K. So in our 10K, we can see that Arista Networks is an industry leader in data-driven client-to-cloud networking. So networking, in terms of data centers, is just a way for different computers to talk to each other. So let's say you have a data center and you have servers, you have storage devices like memory, and you have the internet. All of these things need to talk to each other, right? So if you have a data center somewhere and it can't talk to the outside world, what good is it, right? That's where the growth of cloud computing is really taking off, because you can be in California and you can store your data somewhere on a data center in Texas, for example. I mean, I don't know why you'd want to do that, but that's an example. So networking is very crucial to the build out of data centers because it allows different parts of a data center to talk to each other, and it also allows the data center to talk to the internet, to the outside world, right? To connect data centers to the end user or to other data centers. So basically it involves setting up little paths or routes that data can flow through inside the data center and to the internet so that the data can travel to different destinations. Now we see here, going back to the Meta dilemma, that Meta is a key customer for Arista Networks. They represented 15%, 21%, and 26% of their total revenue for fiscal 2024, 23, and 2022. So what we can see is that revenue from Meta is decreasing. However, Microsoft is the opposite. Microsoft was 16, then 18, and now 20% of revenue. So Meta spending a little bit less on Arista's networking products, Microsoft spending more. So even though this is customer concentration risk, right? The two customers together make up 35% of Arista Networks' revenue. These are quite large customers, and they are spending billions and billions and billions of dollars on their data centers, so it makes sense that these would be key customers of Arista. So I don't find this to be too troubling. Let's talk a bit more about what Arista does, and then we'll dive back into the earnings results. So interestingly enough, Arista was founded by ex-Cisco employees, and actually Cisco is one of their key competitors. So this was a case of Cisco employees getting fed up and saying, you know what, we can do this better, leaving and starting their own company. They started a company, it was called Arista before they changed it to Arista, no joke. And Cisco actually tried to put a stop to this. They filed a lawsuit against Arista, which Arista actually won. The final verdict was made in 2016 and found Arista to be in favor. And ever since then, Arista has been stealing market share from this legacy dinosaur, Cisco. Not saying Cisco's a bad company, but when you look at the growth of Arista versus the growth of Cisco, one is clearly stealing market share while the other is not. Arista's revenue can be broken down into two segments. So they have product and service revenue. Product makes up the vast majority of Arista's revenue. So let's look into what those products are. The two key products here, and yeah, I mean, if you don't have a tech background, this looks pretty daunting, but their two key products are routers and switches. So to put it simply, a router is a device that's used to connect different networks. So let's say you're trying to connect your data center to the internet or to a remote data center. You would use a router. A switch is used to connect from different devices. So let's say two different computers within the same data center. So let's say you need to send data from one computer to another within your own data center, you'd use a switch. If you need to send it to the outside world, you'd use a router. Essentially, these are boxes that a bunch of cables plug into. Data can transfer back and forth in between them. It's very slick. So that's the product revenue, and that's what makes up 84% of Arista's total revenue. And like I said, they're seeing some insane growth thanks to the likes of Meta, the likes of Microsoft, who are building out these massive data centers to support these very advanced computing operations. The other part of Arista's revenue, which makes up only 16%, is services, which they describe here as sales of PCS contracts, which are typically purchased in conjunction with our products. PCS stands for post-contract support. So essentially you're buying a bunch of expensive products from Arista. You also want to make sure that those products stay maintained. So you purchase a contract for Arista to come out and service those products. That's their service revenue. Think of this kind of like what ASML does. They sell these massive machines and then they go out and service those machines. Very similar, just on a much smaller scale for Arista. And this is a very, very, very profitable business. Arista has gross margins of 64% and net profit margins above 40%. So that means of every dollar they sell, 40 cents is profit, cha-ching, in the bank. Also included in their product revenue is their software system. The key software that they offer is this extensible operating system, or EOS, and essentially it is software that goes along with their products to offer things like observability and workflow automation to their customers. So Arista, a very nicely diversified company that really stands to benefit from the build out of data centers. Their key competitor, I would say, is Broadcom, and Broadcom isn't even necessarily a direct competitor. If anything, they're more peers than competitors. Hey you guys, Wyatt from the future here. As I was editing, I realized that I forgot to mention NVIDIA. NVIDIA does also compete with Arista. NVIDIA has their InfiniBand product, which is a competitor to Arista Networks Ethernet products, so they do also see some competition there. Just thought I would mention that. Back to the video. Let's get back to the news. Why is the stock falling? Is it a buy today? Well, looking at the earnings report, we can see that they had full year 2024 revenue of $7 billion, and that's an increase of 20% from the previous year. So this is a very quickly growing company. Like I said, they're taking advantage of that data center build out. And when we look at the outlook, we can see that they're expecting growth to continue to be strong in the first quarter of 2025. They're expecting $1.95 billion in first quarter 2025 revenue, which implies 24% revenue growth. So really nice revenue growth. But again, going back to that article here, the 2025 full year guidance is just going to be 17% year over year. So this implies that growth is going to slow as the year goes on. Still, 17% year over year revenue growth for a company that already made $7 billion in the previous year. That's quite impressive. This shows that Arista is really dominating in the data center networking hardware niche. So clearly this is a very strong business that's not going anywhere, yet the stock is dropping like a rock today. Well, why is that? I think it comes down to valuation. So when we look at Morningstar, again, this is a financial subscription service that I like to look at to help give me a gauge on what analysts think a company is worth. They rate Arista Networks as a 2-star stock, which means they think it's slightly overvalued, and they think the fair value for Arista is $82 per share. So this goes back to a quote that a great company can be a bad investment if you pay too much for it. And I think that's what is going on with Arista today. Great company, very strong execution. However, it has a very steep valuation to match. So let's go over to my spreadsheet here. This is my growth stock spreadsheet where I rate growth stocks on 4 factors. Those are gross margins, annualized revenues, price to annualized sales, and quarterly year-over-year revenue growth. I aggregate these 4 numbers to give a total score for a company. The total possible that you can get is 20. I've never seen a company get that. That would be quite impossible. The average is about 11.5, and Arista gets about 12.5. So Arista is on the higher end of quality growth stocks that I look at. So when I see something like that, my ears immediately perk up. This looks like a good company trading at what appears to be a somewhat reasonable valuation. Let's break down these 4 factors quickly. So like I said, very strong gross margins of 65%. This is non-GAAP. I like to use non-GAAP. However, of that 65% gross margin, only 37% goes to common operating expenses like selling, general and administrative, and research and development. So that means of that 65%, most of it can flow to a net profit. And I really love that. Arista, like I said, is a very profitable company. So when you have a very, very profitable company, you often see higher valuations. And that is certainly the case with Arista. We see a price to annualized sales of about 17. It's not unreasonable. I mean, when you look at some peers on the spreadsheet, right, we have Datadog at about 15, Snowflake at about 18, VSET about 18. It's not uncommon because these companies are very, very profitable. So we also need to look at their price to earnings and price to free cash flows. So Arista, PE ratio of 46. That's a bit higher than the market, but honestly, for a company with double-digit revenue growth, I don't think that's unreasonable. And as of the third quarter, they had quarterly free cash flow of about $1.2 billion. We annualize that is $4.8 billion, which means their annualized price to free cash flow is about 27 times. So that means that the company is trading at 27 times what they make in a year in free cash flow. And free cash flow is simply the cash that hits their balance sheet after all their expenses are paid. So honestly, I believe that that's on the lower end. I would not be surprised to see price to free cash flow be similar to price to earnings. So the fact that it's lower means that they are making more cash than they are profits, right? So that's nice to see. So we have a stock that, even though it's a little bit expensive on a price to sales basis, because they're so profitable, their PE and price to free cash flow are honestly not that high. And that's why I like to look at all three of those metrics. And again, they just grew their revenues at 25% year over year. It's going to slow down to 17, but even still, very strong revenue growth for this company. Last thing I want to look at is the balance sheet. I had a couple of you make a comment that you liked my analysis of the balance sheet for the trade desk. I really nerd out about the balance sheet. I don't know why. I just think it makes a lot of sense. It really can't lie. It shows what's going on with the company. It shows their financial management and how prudent they are with their capital. So one thing that I love about Arista Networks, I'm just going to say, is that they have an amazing balance sheet. So first glance, total assets, right? These are things that have value that the company owns, of $14 billion. First of all, amazing right there. Total liabilities, $4 billion. So they have a net equity value, right? Assets minus liabilities of about $10 billion. That's astounding. We can see that of these assets, current assets, which are short-term things, so this is anything that you could reasonably turn into cash within the year, $12 billion. This is a company with an incredible liquidity position. Their current assets of $12 billion could pay off their total liabilities 3 times over. So that begs the question, what is Arista Networks doing with all this money? Why are they just hoarding their money? Well, we see this with other companies, like Intuitive Surgical just has a fat stack of money that they're just sitting on. I think a lot of times companies like to have options, right? If their stock suddenly drops, they might want to initiate a buyback program where they buy back their own shares and reward the shareholders who have been along for the ride. They might also be looking for strategic acquisitions, right? So maybe if a smaller company that comes along, that's maybe a $5 to $10 billion market cap comes along and Arista wants to acquire that, maybe they want to increase their software offerings, right? Because this is primarily a hardware business. Maybe they want to acquire a $5 to $10 billion software company and they can do that in cash without diluting shareholders. So there's a lot of reasons why a company might have a lot of cash on hand. And honestly, it's just speculation at this point. But what we can say is that Arista Networks has options. They can buy back their shares if the share price drops. They can make acquisitions. They can just hold on to their cash. They can pay off their debt if they want to, if they have any high interest debt. So I'm kind of yapping a little bit, but let's go back to Arista and the valuation and what I think of the stock. So clearly, very remarkable company. They had strong execution. Their growth was accelerating. Now it's decelerating, but it's still very strong in the double digits. Their valuation isn't unreasonable. At a 17 times price to annualized sales with such a profitable company, I mean, like I said, Visa is 18 times because they're also very profitable. So, that's not unreasonable. We also see not too much concentration risk, right? The two key customers, Meta and Microsoft, only 35% of total revenues. It's not unreasonable, right? We can probably expect that those companies are going to continue to spend on their data centers. Even after they're built out, they're going to have to upgrade those data centers to stay competitive. It's not a bad thing to have that customer concentration. And again, just a clean balance sheet. Beautiful, beautiful balance sheet. I love what I see. So honestly, Arista Networks, it is a stock that I already own, so I'm a bit biased, but I do think that this is a wonderful business. And I think that the price, while it may not be wonderful, it's reasonable, it's fair. And I think it's better to buy a wonderful company at a fair price than a fair company at a wonderful price. So I am considering adding to my Arista Networks position today. If I do, all of my YouTube members will know I do offer a YouTube membership. It's $2 a month. If you join, you get to see all the buys and sells that I make. I don't make a ton of them, but when I do, I post it for my YouTube members. It's a great way to support the channel if you wish to do so. Anyway, those are my thoughts on Arista Networks. What do you guys think? Is the drop warranted? Are you buying the dip? Are you waiting? Let me know in the comments below. And if you're new here, please subscribe to the channel. I would love to have you as a subscriber. I post stock deep dives, earnings analyses, and other stock related videos on a pretty regular basis. So if that's something that you like, definitely subscribe, hit that like button, and thank you guys so much for watching. Have an amazing day.